Okay, today in today's video we have a topic IFRS 8 operating segments, and today's topic this is a one type of presentation or lecture which is about the operating segments and the non-operating segments. What is mean by operating segments and what's mean by non-operating segments? Uh, there are the segments which operate and from which we generate revenue, and from non-operating segments and a business line which we are not able to operate, or we are not able to get revenue from our investment. So let's see. First, the scope of the standard. The scope of International Financial Reporting Standard 8 operating segments. IFRS 8 applies to financial statement of any entity of any company whose debt or equity instruments are traded in a public market, or who is seeking to issue any class of instrument in a public market. For example, I'm giving you a government of any country issue treasury bills or any other bonds, or banks issue bonds to public. So when they are issuing their instruments, financial instruments like derivative assets to the public, so this will be included in the scope of the IFRS 8 operating segments. All right. Other entities, other companies that choose to disclose segments information, they appear in those show the information of the segment should make the disclosures in line with IFRS 8 if they describe such disclosure as the segment information. It means that when a company wants that they need to disclose the segment information, so this will be that information will be according to IFRS 8 operating segments. Okay, now identification of operating segments. How can we identify operating segments of the business that it is operating, rather than it is non-operating? All right, IFRS 8 defines an operating segment as a component of an entity. IFRS 8 defines an operating segment as a component of an entity. Operating segment is a one component of a company that engages in revenue earning business activities. Operating segments engages businesses in revenue earning business activities, those activities from which they earn revenues for their businesses, whose operating results are regularly reviewed by the chief operating decision maker. The term chief operating decision maker is not as much defined in IFRS 8 as it refers to a function of rather than a title. It is a function of the business, it is not a title, right? And some entities and some companies, the function could be fulfilled by the group of directors rather than an individual. You don't need an individual. This function can be done by the directors of the company, for which discrete financial information is available. Discrete. Okay. Operating segments. This definition means that not every part of an entity is necessary in operating segments. It is not necessary that every part of the entity of the company would be operating segments, because in the first slide we have defined that operating segments are those segments, those entities which issue their instruments, financial instruments, to the public market. All right, so IFRS 8 quotes the example of the corporate headquarters that may earn no or incidental revenues and so would not be an operating segment. Okay, some commentators have criticized, some people criticize that management approach for this operating segment, for this IFRS 8, too much to discretion of the entity and therefore hindering comparability between financial statement and financial entity. Now, identification of reportable segments. How to identify the reportable segments of an entity? Once an operating segment has been identified, the entity needs to report segment information if the segment meets any of the following quantitative thresholds. Its reported revenue, external and inter-segment, is 10% or more of the combined revenue, internal and external, all the operating segments. It is reported profit or loss is 10% or more than a greater absolute amount the combined profit of all operating segments that did not report a loss, and the combined loss of all operating segments that reported a loss are at at is assets are 10%, its assets are 10% more than combined assets of all the operating segments. So this is the identification of reportable operating segments. IFRS it states that if the total external turnover reported by the operating segments identified by the size criteria is less than 75% of the total entity revenue, then the additional segments needs to be reported on until the 75% level is reached. If segments have similar economic characteristics, then they can be aggregated into a single operating segment and viewed together for the purpose of the size criteria. Now, disclosure by reportable operating segments disclosures. IFRS 8 provides a framework on which to base the reported disclosures. Entities are required to provide general information on such matters as how the reportable segments are identified and the types of product or services from which each reportable segment derives its revenue. Entities are required to report a measure of profit or loss in total assets for each reportable segments. Both should be based on the information provided to the chief operating decision maker, and the chief operating decision maker is regularly provided with information on the liabilities for its operating segments. Then these liabilities should also be reported on the segment basis. IFRS 8 specifies disclosures that are needed regarding profit or loss and assets where the amount are included in the measure of the profit or loss and total assets. Revenues, internal and external. Interest revenue and interest expense. These must not be netted off unless the majority of the segment revenues are from interest and the chief operating decision maker assesses the performance of the segment based on the net interest revenue. Depreciation and amortization, material item of income and expense disclosure separately, share of profit after tax and carrying value of the investment in entities accounted for under the equity method, material non-cash item other than depreciation and amortization, the amount of addition to non-current assets other than financial instrument, deferred tax assets, post-employment benefit assets, and right arising under insurance contracts. So this is explained very much clear and very explained by detail. Entities are required to provide a number of reconciliations. Which reconciliation does entities require to provide? So the total of the reportable segments, revenues of the entity's revenue, the total of the reportable segments profit or loss to the entity's profit or loss, the total of the reportable segments assets to the entity's asset. We separately identified the total of the reportable segments liabilities to entities liabilities and the total of the reportable segments amounts for every other material item disclosed to the corresponding amount for the entity. Alright, so this was all about the operating segments, and you guys can easily understand that what is meant by operating segments is I explained the scope of the standard, and then how to identify these operating segments, and which reconciliations and entities needs to be disclosed at the end of the financial years. Thank you for watching, and see you in the next video.